This report provides a comparative analysis of Coterra Energy, Expand Energy, and Range Resources. To understand the investment thesis for these three companies, one must first analyze the volatile macroeconomic backdrop that has reshaped the sector over the past 24 months. The year 2025 was marked by a stabilization of the post-merger landscape, but January 2026 introduced volatility. Supply and demand imbalance saw U.S. natural gas futures surge over 119% in a mere 5 days. This event exposed the vulnerabilities of the domestic grid while highlighting the massive windfall potential for producers with reliable deliverability and high exposure to spot pricing. Simultaneously, the industrial demand for natural gas is being rewritten by the digital economy. The rapid build-out of artificial intelligence, AI data centers, and high-tech manufacturing facilities has created a new non-seasonal demand sink for natural gas. Forecasts suggest that electric power demand growth will exceed 2% annually through 2026, driven largely by these energy-intensive facilities. This shift has incentivized producers like Coterra to move away from volatile regional benchmarks and toward power netback agreements that link gas realizations directly to electricity prices.
The regulatory environment remains equally fluid. The Environmental Protection Agency finalized the waste emissions charge in late 2024, imposing significant fees on methane emissions above specific thresholds. While the fee is scheduled to rise from $900 per ton in 2024 to $1,500 by 2026, the Republican-controlled Senate and House have signaled a potential repeal via the Congressional Review Act. For the time being, however, the financial burden of methane management remains a primary concern for high-intensity operators. The single most significant tailwind for the U.S. natural gas sector is the projected doubling of LNG export capacity by 2030. Total U.S. liquefaction capacity is expected to add 13.9 billion cubic feet per day, BCFD, between 2025 and 2029. The concentration of these facilities along the Gulf Coast has fundamentally altered the value proposition of the Haynesville Shale and the Appalachian Basin. While the Haynesville offers direct physical proximity, the Appalachian producers, including Range and Coterra, are leveraging new takeaway capacity like the Mountain Valley Pipeline to access these premium markets.
Coterra Energy represents an iteration of the E&P model born from the combination of Cabot Oil and Gas and Cimarex Energy in 2021. This merger created a diversified portfolio that spans the Marcellus Shale, dry gas, the Permian-Delaware Basin, oil and associated gas, and the Anadarko Basin, NGLs and gas. The investment thesis for Coterra is commodity optionality, the ability to shift capital across basins to maximize returns as price signals fluctuate between oil and natural gas. In the third quarter of 2025, Coterra demonstrated the resilience of its diversified model. The company reported net income of $322 million and discretionary cash flow of $1.148 billion. Despite a volatile price tape, Coterra's production surpassed the high end of its guidance, driven by record-setting well performance in the Marcellus and steady execution in the Permian.
Coterra's performance metrics for 3Q 2025 aligned with or exceeded guidance. Total equivalent production, 785 million BOE PD, reaching the high end of the 740 to 790 BOE PD guidance range. Oil production, 166.8 million BOP PD, hitting the high end of the 158 to 168 BOP PD guidance range. Natural gas production, 2,894.6 million MEX-FPD, reaching the high end of the 2,750 to 2,900 MEX-FPD guidance range. Free cash flow, $533 million. Unit operating cost, $9.81 per BOE, falling at the midpoint of the company's annual guidance. Coterra's 2026 outlook is defined by a modestly down capital expenditure profile relative to 2025, while still maintaining 0 to 5% annual BOE growth and approximately 5% oil growth. This strategy reflects management's commitment to a conservative reinvestment rate, which is projected to remain at or below 50%. The company's focus on long lateral extensions and high-intensity completions has allowed it to compress cycle times and lower per-unit costs, particularly in the Permian, where it plans to run 9 rigs through 2026.
In January 2026, Coterra became the center of industry attention following reports of advanced merger talks with Dividend Energy. A combination of these two entities would rank among the largest oil and gas deals in history, creating a premier Permian producer with a combined market capitalization of approximately $45 billion. The strategic logic of the deal is centered on the Delaware Basin, where Coterra holds 346,000 net acres and Devon holds 400,000. This potential merger is viewed as a response to the massive consolidation elsewhere in the basin, such as the Exxon Pioneer and Diamondback Endeavor deals. By achieving greater economies of scale, a combined Coterra-Devon could better control oil field service costs and secure additional infrastructure capacity. Furthermore, activist investors like Kimmeridge Energy Management have voiced support for the deal, noting that the offsetting acreage positions would yield material operational synergies. For Coterra, the merger would solidify its position as a major oil player while retaining its low-cost gas insurance policy in the Marcellus.
Coterra has been a pioneer in diversifying its gas marketing portfolio to escape the limitations of regional basis differentials. In August 2025, the company announced a power netback agreement in the Permian with the CPV Basin Ranch Energy Center. This 7-year deal involves the sale of 50 million cubic feet per day starting in 2028, with pricing indexed to ERCOT West. This mirrors Coterra's strategy in the Marcellus, where it already has 330 million cubic feet per day of production linked to power pricing. On the global front, Coterra's 10-year agreement with Centrica, starting in 2028, provides direct exposure to European gas prices, TTF and NBP, for 100,000 MMBTU per day. By linking its production to international indices, Coterra is effectively acting as a virtual LNG exporter, capturing the spread between low-cost U.S. production and high-value global demand.
The bull case for Coterra is built on its status as the most versatile operator in the large-cap E&P space. Management's ability to turn the dials between oil and gas production ensures that the company is never trapped by a downturn in a single commodity. In a 2026 scenario where natural gas prices recover due to LNG exports and data center demand, Coterra's Marcellus assets, described as its best return in early 2025, can be rapidly re-ramped to capture upside. Furthermore, Coterra's balance sheet is solid, with a net debt to EBITDAX ratio of 0.9x and significant liquidity. This financial strength allows the company to maintain its high shareholder return profile, including a consistent 22-cent quarterly dividend and share repurchases. If the Devon merger is consummated on favorable terms, the resulting entity would possess an inventory duration and operational scale that could lead to a valuation re-rating closer to the super independents like ConocoPhillips. The bear case for Coterra and the primary risk is the strategic dilution and integration friction. A merger with Devon Energy, while promising on paper, introduces the risk of cultural misalignment and the potential for overpayment in an environment where Permian acreage is already at a premium. Critics argue that Coterra's multi-basin model already carries more administrative and operational complexity than its pure-play peers, and doubling down on the Permian could distract from its high-margin Appalachian core. Additionally, Coterra's relative lack of hedging against falling gas prices has been identified as a weakness. While this provides upside in a bull market, it leaves the company exposed during the shoulder months, when gas prices can drop below $2 per MCF. Furthermore, service cost inflation in the Permian remains a persistent threat to margins, especially as the basin reaches maturity and producers are forced to drill less productive Tier 2 acreage.
Expand Energy, created by the merger of Chesapeake Energy and Southwestern Energy in October 2024, has emerged as a leader of the North American natural gas market. With a pro forma production scale of approximately 7.33 BCFE per day, Expand Energy controls the most significant portfolio of gas assets in the Appalachian and Haynesville basins. The company's investment thesis is centered on synergy-driven cash flow and its unique positioning to supply the U.S. Gulf Coast LNG corridor. The central pillar of the Expand Energy story is the realization of $500 million in annual synergies by year-end 2025, increasing to $600 million by 2026. These savings are being achieved through a combination of reduced G&A, optimized drilling schedules, and midstream pricing power. In 3Q25, Expand reported net cash from operations of $1.2 billion and adjusted EBITDAX of $1.08 billion, suggesting that the integration is progressing ahead of schedule. The company's 3Q25 operational highlights include total net production, 7.33 BCFE per day, solidifying its position as the largest producer in North America. Natural gas mix, 92%, indicating high torque to natural gas price movements. Adjusted net income,
$234 million, reflecting strong profitability despite a low-price environment. Net debt reduction, $1.2 billion over the last 12 months, showing a rapidly improving balance sheet. FY25 capital expenditure guidance, $2.85 billion, representing a $75 million reduction from previous estimates.
Expand's ability to reduce its capital expenditure guidance by $75 million, while simultaneously increasing its production guidance midpoint, shows operational efficiency gains realized through the merger. The company is positioning itself to exit 2025 with 12 rigs, creating the productive capacity to grow to 7.5 BCFE per day in 2026, should market conditions justify the ramp-up. While legacy Haynesville assets in East Texas and Louisiana remain the core of the company's near-term growth, Expand Energy has established a 75,000-plus net acre position in the western Haynesville. This region, spanning Robertson, Freestone, and Leon counties, is being heralded as the basin's next growth engine. Early wells in this play have delivered staggering initial production rates of over 40 million megacfe per day. However, the western Haynesville is a technically demanding environment. The reservoirs are found at depths of 17,000 feet or more, with extreme temperatures and overpressured zones. While D&C costs have fallen from $39 million per well to a projected $31 million by 2025, the play still requires gas prices above $4 per MCF to achieve a 20% internal rate of return. For Expand, the western Haynesville represents a high upside call option on long-term gas prices rather than a near-term cash cow.
Expand Energy is the most LNG-ready producer in the world. It was the first U.S. gas producer to execute an LNG SPA and remains the largest supplier of natural gas to Gulf Coast liquefaction facilities. The company's portfolio is balanced between the Gillis Hub, directly connected to LNG terminals, and the Perryville market, serving southeast power demand. The core components of Expand's LNG strategy include physical delivery, currently delivering 1.5 to 1.8 BCF per day to domestic terminals, with a target to increase to over 2.5 BCF per day. International exposure, active sales and purchase agreements, SPAs, with entities like Delfin, with pricing indexed to JKM, TTF, and Brent. Inventory depth, over 15 years of low break-even gas inventory available to support long-term, 20-year contracts. Certification, 100% of production is certified as responsibly sourced gas, RSG, across major basins, allowing for potential premium pricing. Expand's hedge-to-wedge approach, which involves hedging approximately 8 quarters out to reduce cash flow volatility, provides a stable foundation while allowing the company to participate in the wedge of unhedged production as prices rise. This strategy is particularly effective in the Haynesville, where break-evens are higher and price protection is critical for maintaining drilling activity.
The bull case for Expand Energy is a bet on the industrialization of shale. As the largest producer, Expand can achieve a cost structure that is simply inaccessible to smaller peers. The projected $3 billion in annual FCF by 2026 provides the company with massive firepower for shareholder returns and strategic M&A. If natural gas prices trend toward the $3.50 to $4 mid-cycle range as new LNG capacity comes online in 2026 and 2027, Expand's earnings power will be unmatched. Furthermore, the company's dominance in the Haynesville provides it with a structural advantage in the global LNG supply chain. As European and Asian buyers prioritize certified lower-carbon gas, Expand's 100% RSG portfolio will likely command a premium over uncertified production. The Waynesville development adds a layer of long-term growth potential that could see the company dominate the next decade of U.S. gas supply. The bear case for Expand is centered on break-even risk and geographic concentration. While Expand is huge, a significant portion of its inventory resides in the Haynesville, which is a higher cost basin than the Marcellus. If Henry Hub prices remain stuck below $3 per MCF due to oversupply or a mild winter, Expand's Haynesville rig count may be forced into an off-and-on pattern that disrupts operational momentum. Moreover, the company's high debt level, a legacy of the acquisition, requires a disciplined deleveraging effort. While Expand plans to allocate $500 million to debt paydown in late 2025, it remains more sensitive to credit market fluctuations than the lower leverage Coterra. Finally, the execution risk of the Southwestern integration cannot be ignored. Any failure to capture the promised $600 million in synergies would lead to a significant valuation correction.
Range Resources occupies a unique position as the quintessential Appalachian producer.
Focused almost exclusively on the Marcellus Shale in southwest Pennsylvania, Range has built a business model around the lowest unit costs in the industry and a marketing strategy for natural gas liquids, NGLs. While gas prices often dominate the headlines, Range Resources' secret weapon is its NGL portfolio. Liquids comprise over 30% of Range's total production, and the company is the largest exporter of propane and butane among U.S. independents. Through its access to the Marcus Hook terminal on the East Coast, Range can bypass the congested Gulf Coast and export its liquids directly to international markets, where it frequently realizes significant premiums over Mont Belvieu pricing. Range's NGL performance as of 3Q25 highlights this competitive edge. Pre-head NGL price, $22 per barrel, representing a plus $0.33 premium compared to the Mont Belvieu benchmark. Export percentage, approximately 80% of propane and butane production is exported, the highest in the industry. NGL differential guidance, expected premium realization of plus $0.50 to plus $0.75. Production mix, over 30% of total production is comprised of liquids, providing a significant margin uplift. This NGL strategy provides a hedge against low natural gas prices. In 3Q25, Range's pre-head revenue from liquid sales accounted for a substantial portion of its total cash flow, allowing the company to outperform gas-weighted peers during a period of price weakness.
Range Resources boasts a total cash unit cost of $1.91 per MCFE as of 3Q25, an industry-leading figure that includes direct operating, transportation, G&A, and interest expenses. The company has shown its drilling efficiency, having achieved a record 6,250 lateral feet per day in early 2025. The breakdown of Range's unit costs for 3Q25 shows ongoing improvements. Direct operating costs, 11 cents per MCFE, an 8% year-over-year decrease. Transportation and gathering, $1.47 per MCFE, a 3% year-over-year decrease. General and administrative, 17 cents per MCFE, a 6% increase due to scale. Interest expense, 11 cents per MCFE, a 21% decrease following debt paydown. Total cash unit cost, $1.91 per MCFE. Range's ability to reduce its interest expense by 21% year-over-year is the result of its aggressive debt reduction strategy. As of September 2025, net debt stood at $1.23 billion, a level that provides management with the flexibility to return capital to shareholders through both dividends and buybacks. In 3Q25 alone, Range repurchased $56 million in shares while maintaining its quarterly dividend.
For years, the Appalachian Basin was hampered by takeaway constraints that led to punishing local price discounts. The startup of the Mountain Valley Pipeline, MVP, in mid-2024 has fundamentally changed this dynamic. Range has noted that the MVP and other infrastructure improvements have put the Appalachian Basin on firmer footing, allowing for steadier production and better realized pricing. Furthermore, Range is increasingly tapping into in-basin demand. The surge in data center development in the Northeast has created a local market for gas that avoids expensive long-haul transportation fees. CEO Dennis Degner has highlighted that these build-outs provide a long-term demand pull that could support higher regional pricing for years to come. The bull case for Range Resources is a value and quality argument. With a forward PE of roughly 11.85x and a PE growth rate that outpaces its peers, Range is frequently cited as being undervalued relative to its intrinsic cash flow potential. Its 25-year inventory of core Marcellus acreage is the deepest in the industry, ensuring that the company can maintain its low-cost profile for decades. For investors concerned about the volatility of the Permian or the high cost of the Haynesville, Range offers a high-margin, low-risk production. The company's NGL export advantage provides structural upside that is difficult for any other Appalachian producer to replicate, essentially making Range a global NGL player with a domestic gas footprint. The primary bear case for Range is geographic trap and regulatory risk. Unlike Coterra or Expand, Range has nowhere else to go. If the regulatory environment in Pennsylvania becomes hostile, for instance through new fracking bans or more stringent state-level methane taxes, Range's entire asset base would be at risk. While the company is a leader in emissions reduction, it remains a target for local environmental activism. Additionally, Range is highly sensitive to NGL pricing. While this has been a strength, a global economic downturn that reduces demand for petrochemicals could see NGL prices crash, wiping out Range's margin premium. Finally, the Appalachian Basin remains pipeline-constrained in the long run.
While MVP provided relief, there are few major pipeline projects on the horizon, meaning Range's production growth is effectively capped compared to the more flexible Permian and Haynesville players. A direct comparison of the three companies reveals a divergence in valuation and operational focus. The three companies have all made significant strides in debt reduction, but their leverage ratios reflect different stages of corporate maturity. As of late 2025, the leverage and reinvestment profiles are as follows. Coterra Energy, net debt to EBITDAX is 0.9 times, total liquidity is $2.19 billion, net debt is approximately $4 billion, and the reinvestment rate is below 50%. Expand Energy, net debt to EBITDAX ranges between approximately 1.1 times and 1.2 times. Total liquidity is $3.5 billion, supported by an upsized credit facility. Net debt is approximately $5 billion, and the reinvestment rate is between 40% and 50%. Range Resources, net debt to EBITDAX is approximately 1 times, total liquidity is $1.87 billion, net debt is approximately $1.23 billion, and the reinvestment rate is the most conservative at 30% to 40%.
Range Resources has the most conservative reinvestment rate, reflecting its maintenance plus growth philosophy. Coterra's higher liquidity is being preserved for its active leasing program and potential merger activity. Expand Energy's liquidity was recently boosted by an upsized $3.5 billion credit facility, providing the cushion needed to manage its larger scale. The market's perception of these companies is reflected in their forward multiples and price targets. Based on analyst estimates from January 2026, the valuation metrics are Coterra, forward PE ratio of 13.43x, forward PS ratio of 3.12x, dividend yield of 3.6%. Expand Energy, forward PE ratio of 14x, dividend yield of 2.84%. Range Resources, forward PE ratio of 11.85x, forward PS ratio of 3.10x, dividend yield of 0.95%. Expand Energy's buy consensus from analysts is driven by the sheer scale of the merger synergies and the anticipation of massive FCF growth in 2026. Coterra's valuation is somewhat tempered by the uncertainty of the Devon merger talks, though its high dividend yield makes it the favorite for income investors. Range Resources remains the value pick, trading at the lowest forward PE despite having the best unit costs.
As we look toward the remainder of 2026, the competitive landscape for these three firms will be dictated by their ability to execute on their specific strategic niches. In a high gas price environment, $4 plus MMBTU, Expand Energy is the clear winner. Its massive, unhedged production wedge and synergy-driven scale will lead to explosive FCF growth and potentially significant share buybacks. The Haynesville assets, which are more expensive to drill, will see their IRR skyrocket, making Expand the primary beneficiary of the LNG boom. In a volatile or low-price environment, $2.50 to $3 MMBTU, Coterra Energy's model is superior. Its ability to pull capital out of the Marcellus and put it into the oil-rich Permian-Delaware Basin provides a buffer that Range and Expand do not possess. Coterra's high dividend yield and flexible capital allocation make it the most investor-friendly company for those who fear a prolonged gas oversupply. For pure value and efficiency investors, Range Resources is the favorite. Its sub-$2 break-even in the Marcellus and its unique NGL export premiums provide a consistency of cash flow that is unrivaled.